course, your money month here at B&M Bloomberg. Stocks being exposed recently to a lot of volatility, but investors, are they growing complacent about the currency risks involved? According to our next guest, they are. Here to break down the benefits of currency hedging is Adam Budd, Chief Currency Analyst with Forexlive. Adam, always great to have you on the show. This is meant to be obviously a bit of an educational segment as well. So let's start from perhaps some of our novice investors in terms of how you go about currency hedging. Why is it important?
Yeah, I mean, it's a tremendously overlooked risk. We become very complacent about the Canadian dollar, where it is. It's been around these levels for a year. But if you look over the last 10 years, there's a 35% range in the Canadian dollar to the US dollar. So there's a lot of movement that can happen there and will happen there again. And on top of that, there are risks in single stocks as well. Almost every stock in the TSX has exposure to imports or exports or the currency in that sense. So Canadians get very comfortable in this range around the Canadian dollar, but it can absolutely magnify or diminish your returns based on what you're trying to invest in if you get the currency wrong.
All right, Adam. So for those people who haven't been considering their currency risk and hedging strategies, you probably have their full attention now. Bring them in a little deeper. How should they approach this?
Yeah, well, the first thing you have to focus on absolutely is fees. I mean, you can get eaten up by fees in any kind of trade that you do, and there's some brokers in Canada that make all their money on foreign exchange fees. Now, you have to look out in terms of your cash flows first in terms of hedging. If you're buying a house in the U.S. or you're spending half your time there, you're going to want half of your investments or half of your cash flows coming in U.S. dollars. So you can make a structural hedge around that and roll with the punches. Now, if you have a view on the currency, you can also buy a retail FX broker. You can simply make a trade there. It's relatively inexpensive to do. Remember, the currency market is the most liquid market in the world. It's the cheapest market to trade in the world, and it's the easiest market to access. So it's tremendously easy to sell the Canadian dollar in the futures market, in the forward market, or just in the spot retail FX market at extremely low fees.
Let's talk about some of those products that are out there, right? Because there are products specifically designed for hedging purposes.
Yeah, I'm not a big fan of a lot of these. The one reason is you can get in and out of Canadian dollars to US dollars, and that's where most of them are, inexpensively. And like I said, a lot of brokers will charge you far too much to do this, so you get pushed instead into some of these new products. Now, the problem is that's a solution to a problem that really shouldn't be there. There are brokers out there that will, and there are many ways to transfer your money from Canadian to US dollars extremely inexpensively or almost negligible fees. Now, if you want to invest in a basket of global currencies or in Japanese denominated currencies or something foreign, they can be valuable and they can be useful. But I would be careful about those fees eating you up on that kind of trade.
Adam, I understand when we talk about risk, we talk about hedging that risk using currency as a hedge. You're taking a look at the housing market in this country and you're thinking there's a strategy to be executed here. Walk me through that.
Well, if you think about the Canadian dollar, it's a pro-cyclical currency. So if you have good news in the Canadian economy, the Canadian dollar will go up and you'll do really well. So if you're Canadian in that position, you don't really need to hedge to CAD upside risks. You'll get those via your house, via your work. There'll be more jobs and your investments will probably do well in that situation. Whereas on the downside, you can see compounding. If you see the Canadian dollar were to fall, Canadian housing were to fall 20 or 30%, you'd lose money on that side. Your currency would fall as well, and the Canadian stock market. So you have these compounding losses in terms of that. So that's the side you want to hedge on. And in terms of housing, I think we're there right now. We're at this blow-off sort of top portion. I think there was a report out today that said the average Canadian house appreciated $20,000 in the last month. It's comical at these levels, and that's typical of the final stages of any sort of parabolic market. And I think now is the time for Canadians to start thinking about, and this people have said this for years, but to think about ways to hedge that risk if it plays out. And that can mean just opening an account right now. It doesn't mean even funding it. It can mean thinking about how you might do that. And it can be as simple as selling the Canadian dollar in a retail FX account. I mean, the leverage is there. It's very low cost to hold the position open, and you would mitigate some of those risks that we all have right now.
That's a very interesting and provocative thought. Before I let you go, I want to talk to you just about the Canadian dollar and where you might think it's headed. Remember last year you and I had so many discussions of the fact that the Bank of Canada seemed more aggressive than the Fed about eventual rate liftoff, and now we're in a situation where March is bearing down on us and we're expecting liftoff from both central banks. How does this play out for CAD this year?
Yeah, well, there's a lot to like about the Canadian dollar aside from the housing market. The commodity market is extremely strong, and that's in almost everything that Canada sells. I mean, we're juggling this Russia-Ukraine story right now, but as that fades away and as global economies reopen, I think there's a strong case for the Canadian dollar to appreciate in the interim. How Canada copes with rate hikes is another question altogether, and I think we're going to test that over and over. Now, for the remainder of the year, I think the Bank of Canada can hike 100, 150 basis points, and it will be absorbed relatively well. And the Canadian dollar can march ever so slightly higher, which ultimately, if you're looking to hedge those risks, will be a more favorable place to start from.